Been a while since I got onto my whiteboard, but this video is going to be about how interest rates are predicted to be cutting in 2024 and 2025 by an economist, not just some guy on YouTube. So in this video, let's discuss what life could look like if you have an investment property or you're thinking of getting one, and what the numbers actually look like in the next 12 to 24 months. If you're interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, it's definitely been a hot minute since I've actually got onto my whiteboard and shown an example of a couple of things that could play out. And based on what you guys have said as feedback, you guys have actually enjoyed those videos. So let's dive into what's actually happening in the economy right now when it comes to interest rates and how this can affect you in making your decision of whether you buy now or whether you should hold. Now, the chief economist at Westpac has come out and said that, look, we believe that the cash rate will peak at 4.1%. Now, as of recording this right now, we've had the RBA increase to now 3.6%. So that means two more 25 basis point increases. Now, although this could play out, Philip Lowe did come out this week and suggest that maybe it's a time for us to wait, pause, and assess what the indicators are actually saying to us as a result of what the economy is actually doing. So just going out there and blindly increasing or blindly cutting is effectively how we get into a situation where we have to increase the cash rate from 0.1 to 3.6, which is like the fastest increase on record, because they weren't taking into consideration what was actually happening in the economy at the time before they kept cutting rates or keeping them at the point they were. Instead, this time around, they don't want to make the same mistake. So what they're saying is maybe we're going to pause at 3.6%, which means we wouldn't even get to 4.1 as Bill Evans is suggesting. However, if he is right and we do go up to 4.1%, he did follow up that statement and said, well, we will cut in 2024 and 2025 7 times for a total of 175 basis points. So I want to show you exactly what that means for you if you're investing or you have a property right now, because you might be freaking out. Let's dive in. So what happens if rates cut in 2024? So Westpac has said that the peak will be at 4.1%, and then there will be a cut of 7 times. So a total of 175 basis points, which will take our cash rate to 2.35%. Now, just for your reference, the government and the RBA, they're all working together to try and say, hey, let's get inflation between 2 and 3%. At the moment, it's probably like 6.5%. Let's get it to 2 to 3%. What we usually see is the cash rate and the inflation rate pretty much be at the same pace. So that's why when we have inflation at 6.5, yet our current actual cash rate is at like 3.5, you have an issue. But one is lagging behind the other. So I'll save my opinions for much later in this video, but let's continue. Currently, we're at 3.6%, which means that we should have 2 more rate hikes according to Bill Evans. So in today's climate, if we did go ahead and purchase a $450,000 home at a 90% lend, that would mean our loan is of $405,000. Our rent would be $480 per week, which would equate to $24,960 per year. The repayments would be $2,025 per month, and this would equate to $24,300. And at the current rate at 5.5%, that would then go up to about 6%. So I'm basing all of these numbers on 6%. Right now, you could probably get a loan interest only for about 5.5 or 5.75. And moving forward, if we did have the 50 basis point increase, it would then be at 6%, which is what we've calculated these numbers on. Now, other expenses that you would incur would be things like your council rates, water rates, insurances, property management, and possibly some wear and tear. And I've allocated about $6,000 per year based on other examples. Now, before we sort of continue, you're probably asking, okay, well, we're picking up a house for $450,000 and it's renting for $480 per week. Where do I get one of those, Ravi? Well, I run a buyer's agency. It's called Search Property. You'll find a link in the description below to the website where you can check out all the details, as well as check out this video, which is a 35-minute breakdown of how exactly the buyer's agency works to helping you achieve financial freedom earlier. So based on this example, we have an income of $24,960. Our expenses will be the interest repayments here, plus the other expenses, and that would equate to $30,300. Based on this, the cash flow would be negative $5,340 per year, and that would mean $102 per week that's out of your pocket. Now, this definitely is not ideal, especially when we're purchasing property. We were always after positive cash flow properties, but you might find some that are now sitting in neutral or very slightly negative. Now, is this the end of the world? No, it's not. And even if you did have 5 properties like this, you would be, what, $500 per week out of pocket? But if you then look at the bigger picture of how that equity is growing in that investment portfolio and that this is short-lived, that is why you have buffers for when you purchase properties, why you need a strategy. Otherwise, you can see how quickly quickly people can fall behind. Now this is on an example of 450K and buying something that could rent out for 480 per week. If you bought a property that is yielding a 2 or 3% yield, now you're probably negative cash flow by about $15,000 to $16,000 just on the one property. In this case, you could probably weather the storm with another 3 or 4 of these, equivalent to that one that's heavily negative cash flow. That's why it's very important you purchase the right assets in the right locations, because you want demand growing for not just the capital appreciation, but also for the rentals. Now, hypothetically, if Bill Evans is correct, then over the next 24 months, we should see 175 basis points worth of cuts, which means our interest rate will go from 6% down to 4.25%. Now, in that same time, we're going to be super conservative and suggest that the rent will increase by 10%, which basically means 5% the first year, 5% the second year. Again, being super conservative, many areas of Australia right now, they're growing by 15 to 25% in terms of the rental growth. So 10% is definitely conservative, but that's what we're trying to do here. So if we had an increase of 10% in terms of our rent, that would mean that our new rent would be $528 per week. Our repayments will drop significantly given that now the interest rate is 4.25%, and that would mean that our total for the year would be $17,220 per year. I've allocated a little bit more here, about $500 per year, and our total numbers would be that our income is $27,456, our expenses would be $23,720, which means that we're actually now positive cash flow by about $3,736, which is about $71 per week. Now, what do we know in this scenario? $71 per week from one property is not going to get you to financial freedom. And that's fairly obvious. If you've been following me on the channel, you know that it's about getting multiple properties in your portfolio. You also want something that's going to grow both cash flow and capital growth, so demand on both sides, rental, and as well as people wanting to buy your home to live in there. And my opinion on this entire situation is that this is the worst case. We've been super conservative with the fact that we're not seeing rate cuts in 2023. We might see them in 2024. If we see 2 more rate hikes, this is where we're starting to cut from. Again, I don't think we're going to see that given what Philip Lowe's saying, but again, he could go back on his words just like he has before. And we've also been conservative with how quickly those rents are rising as well. Now, my personal belief is that we will see mortgage rates probably between 3 and 4%. Whether that's a variable rate or whether you're going to get that with a fixed rate is going to be a different story. But the idea is that I think we're going to find that long-term average come in between 3 and 4%, which is what we've usually seen. And we're also going interest only at these rates at the moment. If we did go interest plus principal, we would significantly reduce what that interest rate would also be later in the picture. And if we actually decided not to pay down our debt for the next 10 to 15 years, our actual LVR will continue to drop because the value of that property will increase. And we already know that some of the banks are offering greater discounts on their mortgage rates if you've got a 70% or 60% LVR. So naturally, we're going to find ourselves go from an 88% LVR or 90% LVR all the way down to about 60, 40, and 30% if you did nothing with that equity. Now, with one property, you would end up with $3,736 per year positive cash flow. But what happens when you have 4? Or what happens when you have 6? Because that's what we're trying to do here, is scale up the portfolio. Getting 1 or 2 properties, unfortunately, if it's not something you want to hear, is that it's not going to get you to financial freedom. You're probably going to still work till you're 65 and still have a lack of choice. Now, you'll have a lot more than if you hadn't invested, but have the mindset that you need to build a portfolio, not just one property because someone told me it was a good idea. You actually need to have a strategy and a roadmap as to how you execute this and make it sustainable. So in this case, if you had 6 of these properties, within the next 2 years, you would be in a position where you're making about $22,000 in positive cash flow. So if you're thinking about, well, interest rates are so high at the moment, they're always going to stay this high. That's usually what it feels like when you're at the top or when you're at the bottom. When the market was growing in Sydney, it felt like nothing could stop it. But that's what it usually feels when you're right at the top. What we're seeing now is that interest rates are pretty much getting to the peak. The whole financial system is crumbling. We're seeing a lot of businesses go down. We've seen construction halted, and the whole real estate industry is starting to slow down significantly. When you couple that with the fact that we have a supply crunch, not enough homes, and you have immigration to the record levels that are coming in, you probably have a housing crisis. You should definitely go check out my thoughts in this video. Now, cash flow is great because it keeps you in the game. It allows you to hold that portfolio for a longer period of time, but we need capital growth to get out of this game. If you want true financial freedom, you need a combination of both of them. So if we were to break down and say, look, conservatively, we're going to get 5% growth on this portfolio. That means our portfolio of 6 properties is worth 2.7 million, and it would mean that at 5%, we are growing at 135,000 per year in equity. Now just take that in, 135,000, and that's on conservative numbers that it's growing every single year and it compounds. Now, why is this so important?
135,000 doesn't sound like a huge amount.
Well, if you did that for about 7 years, you'd be a millionaire. You'd have $1 million worth of equity just after 7 years. Now, can you honestly ask yourself, based on the job you're doing right now, maybe you've got a partner, maybe you're saving with a sibling or your parents, will you have $1 million in assets or in cash in 7 years' time? Not only that, but that whole portfolio is also then generating you anywhere between $50,000 to $60,000 in positive cash flow. Meaning you could probably start that side hustle, take some time off from work, or maybe you've got a partner that wants to go part-time and then focus on other things like family planning, then you could also go and do that. The key to all of this is that your borrowing capacity is going to be your biggest leverage point, but is also going to be your biggest downfall. Now, I know on this channel I've spoken about,
oh, just buy this many properties, do this, do that.
And then I get comments saying, well,
I can't because I can't borrow.
That's because we're in tightening conditions. The banks have effectively turned off those liquidity taps, but it's all cycles. Understand the process, understand how money works and how the financial system works. We'll have the cycle play out into the next phase, which is when the liquidity taps start opening. As interest rates start falling, your borrowing capacities increase, and you need to consistently look at how to increase your income, because that's how you're able to go and leverage a large amount of debt against productive assets. If you simply go out there and purchase your own home and then expect to go and build a $2 million portfolio, I can tell you now, it is definitely going to take you a lot longer and is harder to actually do. For me personally, I like the rent vesting option. I rent where I want to live and then invest where the numbers make sense. Now I understand that's not for everyone, but that's probably the best strategy when it comes to building wealth at scale with a portfolio. If you're interested in getting help finding the right properties, the right assets in the right markets, then definitely reach out to our team. We've been having a huge amount of inquiries from you guys. You guys are crazy, but I appreciate that so much and I don't want you to miss out. So definitely hit me up and I'll catch you guys in the next one. Thanks guys.